In 2007, while millions of Americans were losing their homes to foreclosure, Goldman Sachs was making billions of dollars by betting against them. This wasn't just opportunistic trading. This was Goldman Sachs creating financial products designed to fail, selling them to clients as safe investments, and then secretly betting that those same products would collapse. When they did collapse, Goldman's clients lost billions. Goldman made billions. And when the scheme was exposed, Goldman paid a fine and moved on. No executives went to jail. No one was held criminally responsible. This is the story of how Goldman Sachs bet against America and got away with it. To understand what Goldman did, you need to understand the machinery of the financial crisis. In the early 2000s, American banks were making enormous numbers of subprime mortgages. These were loans to borrowers with poor credit, high debt, and unstable income. Under normal lending standards, these borrowers would not qualify for mortgages. But banks didn't care about lending standards anymore because they weren't holding the mortgages, they were selling them. Here's how it worked. A bank like Countrywide or Washington Mutual would make a subprime mortgage, then it would sell that mortgage to an investment bank like Goldman Sachs or Morgan Stanley. The investment bank would take thousands of these mortgages and bundle them together into a financial product called a collateralized debt obligation, or CDO. The CDO would be divided into slices called tranches. The top tranche was rated AAA by credit rating agencies like Moody's and Standard & Poor's. This meant it was considered as safe as U.S. Treasury bonds. The lower tranches were rated BBB or lower. They were riskier but paid higher returns. Investment banks sold these CDOs to pension funds, insurance companies, foreign banks, and other institutional investors. The pitch was simple. You're getting AAA-rated securities backed by American real estate. It's safe, it's diversified, and it pays better than Treasury bonds. But there was a problem. The mortgages backing these CDOs were terrible. Borrowers were defaulting at high rates. Home prices were starting to fall. The entire structure was built on fraud. Mortgage brokers lied on loan applications. Appraisers inflated home values. Banks ignored red flags. Credit rating agencies gave AAA ratings to securities filled with subprime garbage because the banks paid them to do it. By 2006, smart traders at a few hedge funds began to realize what was happening. They saw that subprime mortgages were going to default in massive numbers. They saw that CDOs were going to collapse, and they wanted to bet against them. But how do you bet against a CDO? You can't short a CDO the way you short a stock. CDOs aren't traded on exchanges. So Wall Street created a new product, the synthetic CDO. A synthetic CDO doesn't contain actual mortgages. It's a side bet on the performance of mortgages that exist in other CDOs. Here's how it works. A hedge fund manager like John Paulson wants to bet that subprime mortgages will fail. He goes to Goldman Sachs and says, I want to short $1 billion worth of subprime mortgages. Goldman says, okay, we'll create a synthetic CDO. We'll pick a basket of mortgage-backed securities. If those mortgages perform well, you lose money. If they default, you make money. But here's the key. For John Paulson to short the CDO, someone else has to go long. Someone has to take the other side of the bet. Someone has to believe that the mortgages will perform. Goldman's job was to find those investors, and Goldman did find them, but Goldman didn't tell them the truth. In 2007, Goldman Sachs created a synthetic CDO called Abacus 2007 AC1. The deal was worth roughly $1 billion. John Paulson's hedge fund helped select the mortgage-backed securities that went into Abacus. Paulson specifically chose securities that he believed were likely to fail. This is like letting a gambler pick the horses in a race he's betting against. Goldman then sold Abacus to investors. The biggest buyer was IKB, a German bank, a CAA management, a bond insurer. Also invested. These institutions believed they were buying AAA-rated securities backed by residential mortgages. They were not told that John Paulson had selected the mortgages. They were not told that Paulson was betting billions of dollars that those mortgages would fail. Within months, the mortgages in Abacus began defaulting. By early 2008, the entire CDO had collapsed. IKB lost nearly all of its investment. ACA lost hundreds of millions of dollars. John Paulson's hedge fund made roughly $1 billion. And Goldman Sachs made fees and profits from both sides of the deal. This wasn't the only time Goldman did this. Goldman created at least 25 synthetic CDOs between 2004 and 2007. Goldman sold these CDOs to clients while simultaneously shorting them or helping other clients short them. And here's the critical detail. Goldman knew these CDOs were likely to fail. Internal emails show Goldman executives describing their own products as junk and crap. In one email, a Goldman employee described a CDO as one shitty deal. In another, Fabrice Tourre, the Goldman vice president who structured the Abacus deal, called himself the fabulous Fab and bragged about creating securities that he knew would implode. In an email to a friend, Tourre wrote, "The whole building is about to collapse any time now. Only potential survivor, the fabulous Fab, standing in the middle of all these complex, highly leveraged exotic trades he created without necessarily understanding all of the implications of those monstrosities." Tourre knew the CDOs were monstrosities. He knew they would collapse, but he sold them anyway because Goldman was making money. By late 2007, Goldman's top executives also knew the mortgage market was collapsing. In December 2006, Goldman's CFO, David Viniar, reviewed the firm's mortgage positions and concluded that the firm was too exposed to subprime risk. He ordered traders to reduce Goldman's exposure. Goldman didn't just reduce exposure, it went net short, meaning Goldman bet that mortgage-backed securities would fall in value. Between 2007 and 2008, Goldman Sachs made approximately $3.7 billion by betting against mortgage-backed securities. At the same time, Goldman was still selling those securities to clients. Goldman was telling clients, these are good investments, and privately, Goldman was betting they would fail. This is a betrayal of fiduciary duty. When you are an investment bank, your clients trust you. They trust that you are giving them honest advice. They trust that you are not selling them garbage while betting against them. Goldman violated that trust on a massive scale, but Goldman wasn't alone. Other banks did the same thing. Citigroup, Merrill Lynch, UBS, Deutsche Bank. All of them created and sold toxic CDOs while betting against the mortgage market. But Goldman was arguably the most aggressive and the most profitable. In April 2010, the Securities and Exchange Commission filed a civil fraud lawsuit against Goldman Sachs. The SEC charged that Goldman misled investors in the Abacus deal by failing to disclose that John Paulson had selected the mortgages and was betting against the CDO. Goldman denied wrongdoing. Goldman's lawyers argued that the investors were sophisticated institutions. They argued that IKB and ACA should have known the risks. They argued that Goldman had no duty to disclose Paulson's role. But the evidence was damning. The SEC had internal Goldman emails. The SEC had testimony showing that ACA believed Paulson was investing alongside them, not betting against them. The SEC had proof that Goldman deliberately withheld material information. In July 2010, Goldman settled with the SEC for $550 million. This was the largest penalty ever paid by a Wall Street firm to the SEC at that time. But it was a tiny fraction of what Goldman made from mortgage shorts. And critically, the settlement required no admission of wrongdoing. Goldman paid the fine and moved on. Fabrice Tourre was also charged by the SEC. Unlike Goldman, Tourre fought the case. In 2013, a jury found Tourre liable on 6 of 7 counts of securities fraud. He was fined and banned from the securities industry, but Tourre never faced criminal charges. He never went to jail. Why not? Because what Goldman did, while morally reprehensible, was not clearly illegal. Fraud requires proof of intent to deceive. Goldman's lawyers argued that the investors were sophisticated, that they should have done their own due diligence, that Goldman had no obligation to disclose everything, and technically they were right. There is no law that says an investment bank can't bet against its own clients. There is no law that says you have to tell your clients that you think the securities you're selling them are garbage. As long as you don't make explicitly false statements, you can sell bad products and profit from their failure. This is the loophole that Goldman exploited. And this is why no one went to jail. In April 2010, Lloyd Blankfein, Goldman's CEO, testified before the Senate Permanent Subcommittee on Investigations. Senator Carl Levin questioned Blankfein about Goldman's conduct. Levin asked, "Did Goldman have a duty to tell clients that you were betting against the very securities you were selling them?" Blankfein dodged the question. He said that Goldman was a market maker, that market makers take both sides of trades, that clients understood this. Levin pressed him. He read from internal Goldman emails showing executives calling their own products crap and junk. Blankfein insisted Goldman did nothing wrong. At one point during the hearing, Levin asked Blankfein, "Do you think your conduct was ethical?" Blankfein paused, then said, "I think our conduct was appropriate." The hearing became infamous. Video clips circulated showing Blankfein squirming under questioning. But nothing changed. Goldman paid the fine. The executives kept their jobs. The bonuses kept flowing. In 2009, Lloyd Blankfein's compensation was $68 million. The financial crisis destroyed lives. 9 million Americans lost their homes to foreclosure. 8.7 million Americans lost their jobs. Millions more lost their savings and retirement funds. The crisis cost the American economy an estimated $13 trillion. Goldman Sachs didn't cause the entire crisis, but Goldman was a major participant. Goldman helped create and sell the toxic securities that spread the contagion through the global financial system, and Goldman profited massively from the collapse. But here's the deeper problem. Goldman Sachs was bailed out. In September 2008, after Lehman Brothers collapsed, the federal government stepped in to save the financial system. The Treasury Department and Federal Reserve provided trillions of dollars in loans, guarantees, and capital to major banks. Goldman received $10 billion in TARP funds. Goldman also received $12.9 billion from AIG's bailout. When the government rescued AIG, it paid AIG's counterparties 100 cents on the dollar. Goldman was AIG's largest counterparty. Goldman collected billions in taxpayer money. Without the bailout, Goldman might have failed, but Goldman was deemed too big to fail. The government decided that allowing Goldman to collapse would be too dangerous, so taxpayers rescued Goldman, and within a year, Goldman was profitable again and paying massive bonuses. This is moral hazard on a historic scale. Moral hazard means that if you're protected from the consequences of your actions, you have no incentive to behave responsibly. Goldman took enormous risks. Goldman sold fraudulent securities. Goldman bet against its own clients, and when those bets went bad for the financial system, taxpayers bailed Goldman out. Goldman executives faced no criminal penalties. They paid a fine that was small relative to their profits, and they continued doing business as usual. The pattern hasn't changed. In the years since 2008, Goldman has been fined repeatedly for misconduct. In 2012, Goldman paid $22 million to settle SEC charges related to improperly handling confidential client information. In 2016, Goldman paid $1 billion to settle claims related to mortgage-backed securities fraud. In 2020, Goldman paid $9 billion to settle charges related to the 1MDB scandal in Malaysia. Each time, Goldman pays a fine. Each time, there are no criminal charges. Each time, executives keep their jobs and their wealth. And each time, the message is clear. If you're a major Wall Street bank, you can break the rules, pay a fine, and move on. Goldman Sachs bet against America. Goldman sold toxic securities to clients while secretly betting those securities would fail. Goldman made billions while clients lost billions. And when the scheme was exposed, Goldman paid a fine and faced no criminal consequences. This is not a story about a few rogue traders. This is a story about systemic corruption, about a financial system that rewards betrayal, about a legal system that protects the wealthy and powerful, about a government that bails out banks but not homeowners. The 2008 financial crisis revealed that too-big-to-fail banks operate with impunity. They can take enormous risks, commit fraud, and destroy the economy, knowing that they will be bailed out and face minimal consequences. This is not capitalism. This is crony capitalism. This is a system where profits are privatized and losses are socialized. Goldman Sachs didn't just bet against subprime mortgages. Goldman bet against the idea that actions have consequences. Goldman bet that the government would protect them. Goldman bet that they were too big to fail. And Goldman was right. This is the story of how Goldman Sachs bet against America and won. How a Wall Street bank created financial products designed to fail, sold them to clients as safe investments, and then profited when they collapsed. How executives called their own products crap and junk but sold them anyway. How the SEC filed fraud charges but settled for a fine. How no one went to jail. How taxpayers bailed out the banks. And how 15 years later, the same banks are still too big to fail, still taking excessive risks, and still confident that when the next crisis comes, they will be rescued again. Goldman Sachs bet against America, and America lost.